Let's get to the stock of the day, and I dare say valuation might come into the story here. So I picked REA because shares have lost around 40% of their value over the past 12 months. We've got concerns over the softening housing market, increased regulatory scrutiny over steep agent price hikes, and a recent tech-driven shift by rival Domain. Just today, Citi has cut its 2027 profit forecast for REA, flagging a near-term risk from negative gearing and CGT changes. The investment bank expects housing listings to decline 5% in FY27, but it does say the market reaction has been overdone. So it has reiterated its buy on the company, but a lower $181.15 target price today. You can see there, shares getting a bit beaten up yet again. But Luke, does therein lie the opportunity, or are there bigger fundamental problems when it comes to REA?
I think, with a business like REA, you kind of want to take it back to first principles. And if you're, about to sell your house or sell an investment property, and the agents that you're kind of interviewing to come to do the appraisals on that house and potentially get your business to sell that house said to you, look, our strategy is actually we're just going to list it only on Domain and Facebook Marketplace, and we're not going to list the property on REA. Do you reckon you'll go hire that agent? I don't think you are. So, I still think that REA's sort of dominant market position is sort of irreplaceable. And, as I've sort of said elsewhere recently, whilst you can sort of code your way, to a product that looks and feels a bit like REA, you certainly can't go and get the relationships with the agents and the agencies or the listings or create that kind of demand that we just talked about where, a vendor's never going to really want to sell their property without paying REA on the way through. So, they're able to put prices up every year because they're an essential monopoly business. You can buy that business now on a 10-year low valuation, kind of depending on how you want to look at it. And I really do think that whilst you're seeing Citi and others sort of downgrade price targets and cut listing volumes, I think the pricing mechanisms, the margin expansion opportunity these guys have, and the market position is sort of being sort of thrown out, I suppose, with maybe a bit of short-termism. And, in this particular instance, I think analysts just wanting to make an excuse to get their target price a little bit closer to the current share price so they look a little bit less stupid in front of their institutional clients. So, brokers have a tendency to do that. Wouldn't be too worried about today's price move. I think it's a clear buy and still one of the best stocks on the ASX, in my opinion.
Never one to mince words, our Luke Laretive. All right, let's get to Adam Dawes' view on REA. And I've got to say, just having a little bit of experience with some of the aforementioned process you've got to go through to list a place mentioned by Luke, it is almost like a captive market. I mean, it's become shorthand for listings, and it is exy.
It is certainly, and obviously real estate agents love it as well because they probably put a margin on top of that as well because they call that marketing costs. So yeah, absolutely, it is lucrative. But I sort of think this has been a bit of a perfect storm for REA. You remember they talked about ChatGPT eating their lunch and basically trying to take over that section. You got Domain coming in with the new American partner who's going to throw some more money at it as well. So REA has had a little bit of a tough time going forward. UBS also downgraded the stock on Thursday. So Citigroup's just following that. And I do agree with Luke as far as the overall concept of reducing your target price just because the share price is lower. It's a good reason. UBS did say that they're going to see 10% lower listing volumes for this year and next year. So there is that. And they did reduce their share price by 23%, share price target by 23% to $165. So it does look like it's still in some good buying range here. I am a little bit cautious about REA as far as that we have seen auctions rates started to fall. We're here in Sydney. I think they're around about sort of 45%. Normally they're around about 80% for sort of the same time in the year. So it does show that the market is changing. Now, obviously, if these CGT changes don't go through, which seems like it might not, but if that doesn't happen, then REA is an absolute screamer of a buy because that turnaround on those listing volumes will increase. But everybody still needs to sell. In the short term, we might see a lot of investors unloading some of their properties as well. again, you need to be with REA for that as well. So, look, for me, it's a neutral. I'm going to say hold. There's too many unknowns in there. I still do have some clients in it, so we're going to sort of sit there and see how this thing goes. But if some of those CGT changes do happen, I think this might be a really good buy. But for me, it would be a hold at the moment.
Okay, all right. I take your point, though. If investors do sell, it just means more listings for REA.